And so our next session is following the theme of talking about particular types of investments. And so I am very pleased to welcome Idalin. And I apologize for not checking in with you about how to properly pronounce your name. Is that okay? Idalin? Idalin, perfect. Idalin McKenzie, VP, Vice President of Finance and Asset Management at the YWCA. Thank you.
Hamilton, thank you. And all right, good afternoon, everyone. It is certainly a pleasure to be here with you to talk about balancing mission-related investments and returns. Today, we'll explore how MRIs have become a crucial strategy for foundations, philanthropic organizations, and nonprofits. As we look at the objectives today, we will be looking at exploring how impact-driven organizations can align investments to achieve social and environmental impact while generating financial returns. It's having the funds to invest, but also recognizing the impact we would like to achieve from them. So when we hear the term MRIs or mission-related investments, we think of investments naturally, and they work in a similar way, but with a twist. MRIs are made with a dual purpose of achieving both a financial return as well as advancing a social or an environmental mission. These investments will allow organizations to use capital strategically, driving both profit as well as a positive impact. The primary aim of the MRI, therefore, is to generate a long-term social impact while ensuring, as we've heard in previous talks, measurable financial returns. It's asking that question, how do we align capital with our mission to advance our goals? Unlike traditional philanthropy, which many organizations are quite familiar with, and donors, the focus is on providing donation with respect to money or time. However, MRIs are really about investing strategically into projects or companies, that create social good while generating financial returns. I could get back to work. So when we think of MRIs, it's really about finding those projects or organizations to invest in, and MRIs can achieve both the social impact as well as environmental impact. So when we look at some possible examples of potential investments, we can turn to affordable housing, an area, for example, like YWCA Hamilton, we're heavily vested. MRIs are being used to fund these projects, and we see them like real estate funds or public or private partnerships that address the critical need for affordable housing while generating rental income. So we're seeing the balance there of the social good with financial returns. We can also look to education as another possibility, where MRIs are being used to fund EdTech. You might see a lot of technology coming out to advance education. Or you're investing in schools particularly we see this big in the US, in underserved communities, helping to close the education gap and provide a more equitable outcome for the underserved. Then we switch to gender equality. We see MRIs being invested there as well. MRIs are also being invested to prevent homelessness. So what we're seeing is that MRIs can be used to create change across sectors, driving meaningful impact. But then we can also turn to the more climate environmental aspect as well when we think of mission-related investments. And we see MRIs in investing, for example, renewable energy, where we're seeing funds investing in clean energy projects, solar, wind, hydroelectric power, reducing our dependency on fossil fuels. Energy efficiency is also another type of project or companies where MRIs can be invested in, where the focus is on technologies to improve energy use, such as LED lighting and smart grids and so on. We turn to sustainable agriculture as another investment idea for MRIs, green building. So the key here is that MRIs offers environmental benefits and strong financial returns. They help tackle those big issues that we need to address as a broader society. So that's about the impact of MRIs across sector, whether it be social or environmental. But what about the financial returns? So when we think of the financial returns, we might be thinking, can we get market-based returns from these investments? Or do we compromise on that? So while MRIs focus on impact, they can also offer comparable, as we've heard, and I'm sure you've heard in other sessions, comparable financial returns supporting growth of the organization and the reinvestment of those returns into the organization's mission. Returns definitely do vary. You could see at market rate, below or above market rate. But the key for any organization is really a diversified strategy as they put that MRI, decide on their MRI investments or mission-related investments. So coming to the question about balancing impact and return, we can see that there certainly can be a trade-off. Are we going for impact? Are we going to go for return as an organization? Or do we want to find that sweet spot where we're balancing both? So when we balance both, we strive to achieve financial returns and social or environmental impact. So our focus is on diversifying, having a diversified strategy, which is mission aligned to our needs as an organization. When we choose mission first, organization prioritize impact over return. So an organization might choose a lower return, knowing that they're achieving the impact. A return first approach, the primary focus is on the financial returns, with social or environmental becoming a secondary consideration for the organization. This, though yield higher return, it may come into conflict with an organization in terms of the goals it has set for itself. So it's important to take away from this is that balancing impact and financial returns is actually crucial when we think about MRIs. Whether you are prioritizing impact or return, it's important to understand these strategies to help your organization make the decision about the respective investment. So no investment is without risk, of course, and navigating risk and return is also another important consideration. And so as an organization look to invest in MRIs, it's also thinking about which vehicle or which investment is ideal for the organization based on the risk that it's willing to take. What's the risk appetite of the organization? So when we consider debt investment, I've heard in the previous they talk about bonds. Debt investment tend to offer stable with lower risk and modest returns, like loans and bonds for social impact projects. Then we could look to equity investments, which carry a higher risk but offer greater potential returns, such as investment in social enterprises. But I want to touch a bit on the blended finance model, which combines what we call philanthropic and private capital, balancing the risk of both social impact and financial returns, making it a win-win for both social impact as well as the financial returns. So when we think of blended finance model, which combines philanthropic capital and private investment for those high impact projects, the foundations and the government provide what we call catalytic capital, reducing the risk for private investors while private capital scales these initiatives. One of the key features with the blended finance model is what we call the first loss capital, where the philanthropic organization absorbs the initial losses, helping to attract private investors by mitigating their risk. So this model allows for organizations to pursue high-impact goals like reducing poverty or promoting sustainable energy while managing the financial risk. So how do we structure an MRI strategy? So we know MRIs are good for endowments, nonprofits, philanthropic organizations. But how do we structure them? Start by selecting sectors that align with your mission and have strong market potential. Is it environmental? Is it around social causes, houses, education? Right? Renewable energy as another example. The next thing is about diversifying, incorporating impact investing funds to reduce risk to achieve both your impact as well as your financial return. And then, of course, you can target certain growth sectors, do a bit of research to see which sectors are offering the greater return for your organization. And again, balancing, finding a bit of both. Are you balancing impact and, of course, the return, and where is that trade-off? So when we implement an MRI strategy, it's also important that it's not one and done. It's about the evaluation, evaluating the social and environmental impact. So you're getting your return, but are you achieving the goals that you set out to achieve? Or is this investment returning the impact that you envision? But why do we measure impact? We are measuring impact because we want to demonstrate that we are having tangible outcomes from these investments. It's also confirming that the investments continue to align with our organization's mission. Key metrics that we can consider as we assess these investments, depending if it's a social or an environmental type investment. We can look at the number of people served, how many people benefited from your investment, like affordable housing, education as an example. Look at the investment in terms of the environmental benefits that it claimed to, it's going to claim to achieve. What are you seeing with respect to the reduction in emissions or water conservation as an example? You could look at that. Look at investments around economic empowerment for the underserved, if that's your mission and your investment as a result. Look at metrics like job creation or income growth among the underserved. When we measure social and environmental impact, it ensures that MRIs not only generate financial returns, but also contribute to the lasting positive change that we are trying to create as organizations. So now we've gone through MRIs, we've looked at balancing the impact with the return. We know the importance of measuring them and know that it's a continuation of reevaluating how we're doing and making sure we're spending the dollars or investing our dollars in a way that's returning and it's in alignment with our mission. What steps do we take to implement MRI? So we know it's a good thing to do. What steps should we be taking? First, it is important to define your investment thesis. It is about making sure your mission is at the heart of every investment decision you are making. Next, you want to diversify your portfolio because, again, it's risk and certainly return. You want to diversify your portfolio. This helps you to manage your risk and boost any potential returns. But certainly, again, what about the impact? We need to track social and environmental outcomes, specifically if they're achieving the change we want to see. So be clear on the change you want to see. How is this investment in alignment with the change that you want to see? And measure and monitor the investment for its impact, not just its return. Finally, in your action plan, don't be afraid to adjust your strategy because oftentimes we make an investment, it's going well, and we pretty much leave it going without assessing, is it continuing to align with the strategy of the organization? How has our organization outlook changed since our last investment? Is this investment continue to be in alignment? So don't be afraid to adjust your strategy around your MRIs. And certainly tweak and redirect your investments if needs be. So I want to take you through just a quick case study with respect to the Ford Foundation. So the Ford Foundation was established in 1936 and is one of the largest philanthropic organizations in the world, with a mission to advance social justice and reduce inequality. In this case study, I will show how Ford uses its endowment to make investments that not only generate financial return, but also drive social impact. So the Ford Foundation has an endowment of about $13 billion, and it has committed 10% of this endowment to mission-related investments. This endowment is fueled by a combination of donation, bequest, and other philanthropic contributions, of course, from individuals, organizations, and other institutional donors. Through this approach of mission-related investment, the Ford Foundation has ensured that sustainable funding base of its investment in social and affordable housing, clean energy, and other initiatives that align with its mission. So it's ensuring, again, where we talk about ensuring that you know what your investment thesis is, know that your investments are in alignment with your mission. The Ford's Foundation mission-related investments is grounded in its commitment to social justice. The foundation focuses its MRIs on 4 main areas: social justice, advancing civil rights, gender equality, and economic justice. It also focuses on climate change and sustainability as another focus area, investing in clean energy and sustainable agriculture projects that mitigate climate change. And again, financial inclusion is another area of its focus. The key here is to make investments that's driving the systemic change. So as an organization interested in advancing or moving ahead with mission-related investment, is to think about what are those causes that are in alignment with your mission and you want to see the systemic change. Now, how does Ford decide on which MRI? So it knows its mission, it knows its focus area, its investment thesis, but how does it decide? The Ford Foundation employs a rigorous due diligence process when selecting its MRIs, because there's lots of projects and companies you can invest in, and of course, foundations. But before making any investment decision, the Ford Foundation assesses against its investment thesis. It asks these questions for social impact. Will this company, will this project create economic opportunities for underserved communities? Will it reduce environmental harm? The financial viability of the investment is also assessed. The foundation ensures that the project will be sustainable financially. So it has to evaluate that as well. And of course, there is the ongoing monitoring as well with regards to the investments. So when we look at potential MRIs that we are seeing the Ford Foundation investing in, quite familiar that we've heard throughout this seminar, we've heard about affordable housing projects, impact funds, renewable energy, and of course, financial inclusion projects and the outcomes associated with those. So, in concluding, the Ford Foundation's approach to MRI shows how large-scale philanthropic organizations can integrate both social impact and financial sustainability into its investment strategies. By focusing on sectors like clean energy, affordable housing, and financial returns, and financial inclusion, as an example, the Ford Foundation is driving both impact as well as financial returns as well. So they're finding that balance. For large nonprofit organizations, one can allocate a portion of its endowment for MRIs, or of course, your reserves, to create sustainable income and create long-term impact. For smaller nonprofit organizations, we can partner with impact investors or access social impact funds to achieve their mission and deliver measurable benefits, starting small and then growing after that. When we think of MRIs, therefore, we should think of it as a strategic approach to our investing and recognize it for the tool that it is, which is actually a powerful tool that to help us balance returns while continue to advance our mission as an organization. Another key point is that we remain adaptable throughout our journey with MRI. We'll start small and, of course, be flexible, be adaptable, because the concept of MRI is certainly changing, and organizations are also changing. And so it's being clear around your objectives and do your research with respect to the organizations and projects that you can invest in to align and drive your impact. Thank you.
That was fabulous. Thank you, Idalin.
Thank you.
Does anybody, we have a few minutes for questions. Does anybody have anything they would like to ask? Again, you can just put up your hand and somebody with the mic will show up. And I guess while people think about it, I wonder, is there, in your experience, is there something that folks, I mean, you gave us a lot to think about, absolutely. But is there one thing from your own experience that you're like, oh, if I'd only known this about mission-related investing, I would have maybe done something differently? Like, is there an example or something that went really well, maybe?
Yes. In my experience, what I think is that it's making it. It's not thinking about it beforehand or putting in place, having the conversation, particularly at a strategic level, whether it be at the board level or at the executive level, about how our organization is thinking about investments, mission-related investments, and having that conversation early and putting in place a policy to help drive decision-making around mission-related investments. So that I would say as, something that it's now forefront for me and my organizations, and of course the boards that I sit on. It's really thinking about it and making it core to your organizational strategy.
Do you allocate like a particular percentage of their portfolios to mission-related, or does it depend?
Not at this time. What we do have in our policy, clear guidelines that we need to have consideration for the mission side of the investment and its impact it's having in the broader community, whether through social services or, of course, the environment. So thinking about those things as we make investment decision and asking the question, because sometimes you go and you're investing with a bank or another investing company and you're thinking about, you're getting the fund, but you're seeing the return, which is the first thing you think about, but not thinking about the impact side. So it's now having those conversations early in the process.
Oh, there's one at the back there.
Sorry, a question you mentioned earlier about taking on the first loss or first loss risk. Could you speak just really quickly about how that, I mean, assuming you're taking on the default of that to entice investments?
That's right, because so with the first loss, the concept here is that whether it be the government or the philanthropic organization, they take that very first loss to that project or that investment. And so it's not borne by the investor or the private investor. So that's the concept there.
All right.
Is that
Go ahead.
I mean, is there a high default rate on that, or is that, I mean, it seems to be quite a significant loss should there be an issue with?
I think with this, with respect to that first loss, in terms of the default rate, I do not have like the specific number in terms of the default rate there. But what you can think of it as is, whether it be, and I just not to share confidential information what it is right now, it's like you're building a low-income housing project, and it's costing about $50 million, but you've put your case together that this will generate certain amount of return, but you've only secured about 20% of that from the municipality or the government. But you do need to attract private investors into that project, so it's their guarantee that were there to be a loss, either the municipality, another philanthropic organization, or a foundation would guarantee that first loss component.
I understand. Thank you.
Excellent. Thank you so
Thank you so
much.
much.
We're out of time, but really appreciate that. Thank you.